Mohammed. I'm from the University of Toledo. I graduated this December with an MBA with concentration in finance and a master in economics. Most important was actually to learn the dynamics of a team, because we needed to know each other and know the strengths and weaknesses of each member, and then we go ahead and divide the work accordingly. The sudden changes of both the company itself and our decisions. We had limited time, we needed to make decisions really fast, and we needed to get them done according to the time limits. Yes and no. Yes, because with the level of and depth of the analysis that we needed to come up with, yes, definitely all the analysts in the real world actually doing that. And the reason I say no, because none of our team members were healthcare analysts, but in the real world, you're going to be analyzing companies within your own sectors. It actually got us more excited about analyzing companies and doing evaluations for more and more. So definitely most of our team members are more enthusiastic to working into the industry, and I think 4 of our team members actually are sitting for the CFA exam this June.
So we're from the University of Toledo. We'll be presenting a buy recommendation for Perigo. It's based off of our analysis of the company. My name is Andrew Dilley.
My name is Derek Jones.
I'm Wing.
I'm Mohammed.
I'm Sonny.
Before we get into the valuations, just a little bit about the company. Perigo produces and distributes generic pharmaceuticals. They operate under 4 main business segments: consumer healthcare, nutritionals, pharmaceuticals, and API. In 2012, they also acquired pet care industries from surgeons, but it's not currently listed as one of their main business segments. This is a revenue breakdown, or segment by revenue. As you can see, consumer healthcare makes up 57% of their revenue, while API, their smallest, only makes up 5%. And then this shows a little bit more detail, their subsegments. We left this slide consistent with what we submitted on the 4th. The price has actually gone up to $108.30, 2.4% gain since then.
So the next thing we're going to talk about is our target price. Based on a combination of our free cash flow to equity model, multiple analysis based off our team's estimates, we came up with a target price of $125.50, which at the time we submitted it was an 18.99% gain overall, including the 0.31% dividend yield. But since the price increased, it's now 16.19. So I mean, come on, things are already going up since we recommended it.
Okay, so we did this SWOT analysis to evaluate the company strategically. So here's some highlight about this analysis. This company have really strong supply chains, which they have a good relationship with their customer like Walmart, Target, and CVS. And however, they don't have a distribution channel in Europe. Furthermore, the economic turmoil happening in Europe right now is there's more incentive to increase the demand in generic products. We come up with our buy recommendation based on 3 main factors. First is industry, second, the growth opportunity of this company, and the third one is our valuation. So here's some overview about this pharmaceutical industry. According to Columbus, in US is 80% of medicine consumption is generic products. And here's some positive factor about this pharmaceutical industry. They have high demand because the poor economic condition, and expected growth rate for this industry is about 8.56% for this year. And moreover, the population getting older, this means the consumption rate is kind of increasing for this industry as well. Lastly is our healthcare reform. It means the government is going to spend more for the healthcare division like Medicare, or Medicaid. which also increased the consumption rate in the healthcare product in general and the pharmaceutical product particular.
This is our risk matrix. If you look at the vertical axis, the top side indicates higher impact and the bottom side indicates a lower impact. If you look at the horizontal axis, the right side indicates higher probability and the left side indicates a lower probability. And the reason we're showing you this to point out that Perrigo doesn't have any high impact, high probability risks, which supports our buy recommendation for the company. Also, we looked at the risk from three perspectives: the macro, industry, and the company specific. Our main concern under macro is healthcare reform and all the uncertainty around it. On the industry side, the possibility of Johnson & Johnson coming back to compete in the generics. Company specific, the fact that Walmart makes up 20% of their revenues. If Walmart decided to go ahead and change, that would have a high impact on the company.
So next we're going to go over a relative analysis for Perrigo. It was kind of hard to pick a peer group because there's no one company that does everything that they do. There might be a company that competes against their consumer healthcare segment, there might be one that competes against their API, but no one company that encompasses all of their different business segments. So what we did was we took the global peers as listed by Bloomberg. As you can see, Perrigo is undervalued by all the metrics except EV to EBITDA, and that's due to the recent acquisitions that they've made. They have more goodwill to amortize.
We evaluate the stock price of Perrigo based on two models. First, which is multiples, and on the left side, we use the team's estimates, and based on price to earnings, book, and the cash flow, we get a target price of 109.70 cents. For comparison, we use the same ratios from Bloomberg, and we got a target price of 120.20 cents. So we used the very conservative consumptions in our multiples, but we still got buy recommendation finally. So that means the investors get a more return when they purchase stock.
The next model that we did was a two-stage free cash flow to equity model. We figured it would be good to encompass some sort of discounted cash flow model. And as you can see, underneath the thick black line is kind of the meat of this. Using a two-stage free cash flow to equity model with conservative assumptions in our growth rates and our terminal growth rate, we arrived at a target price of $127.83. So another thing that we wanted to talk about, the reason that Andrew had mentioned the institutional holdings is because they're more likely to use a discounted cash flow model than multiples to value a company. So we weighted it accordingly, and by using the weights for the multiples and the free cash flow to equity, we arrived at our target price of $125.50.
Here are some financial analyses. Based on those standards, Perrigo did a better job during the last 5 years. You can see the trend, and we are expecting the trend will be maintained. And during the last 5 years, Perrigo did a good job in terms of the operating margin of the overall company, and we further break down the three main segments, and each segment showed strong growth. This is really good news. In fiscal year 2008, the consumer healthcare accounts for 80% of the total revenue of Perrigo, which has a relatively low operating margin. However, in fiscal year 2012, because of other more faster growing segments, at the same time, there are more profitable segments. Consumer healthcare accounts for 60% of the total revenue of Perrigo. So based on the return, operating margin, and revenue structure, we think Perrigo transferred itself from good to great, and it's time for the investors to put the right investment in the right company to get the right return compared to the market.
This graph compares the Perrigo growth, compares the organic versus the inorganic growth of Perrigo. Over the past 7 years, they had 9 CAGR% of growth organically and 44% CAGR inorganically.
So now to go a little more in depth about the inorganic growth. As you can see, there are the three companies that were mentioned earlier. Paddock Laboratories, because of this acquisition in 2011, they now have 37 patents pending by the FDA, which gives them their RX business's greatest pipeline in Perrigo's history. As you can also see, the acquisition of Surgeons The branded product, which is like Frontline, it's mostly for topical flea and tick prevention, things of that nature. It accounted for $1 billion, which surgeon sales in their most recent fiscal year were $140 million. And they just announced on February 1st when they released their earnings that they're acquiring Valsera, which is more traditional pet medications, oral medications, things of that nature, which accounts for $60 million in sales.
So we only had a 10-minute presentation. We fit a lot of information here, so just to go over, we talked about the company strategically, we talked about their growth opportunities, we talked about their financial trends, as well as our valuations based off of our performance. We received a target price of $125.50.
We think this company is a strong buy.
Yeah.
Any questions?
At this point, we will begin the Q&A session.
In your SWOT analysis, you talked about the weaknesses that the company has. Can you talk a little bit more about that? And one of the strengths, one of the points you have was low leverage. What would be what would you consider to be a high leverage company in this industry, or a high level of leverage for a company in this industry?
Debt at least twice times their equity.
I'm sorry?
Debt at least twice their equity. For some
Okay.
reason the mouse isn't working. I was going to go to the slide, but just do it this way.
And can you tell me a little bit about what tarnished reputation? What does that entail?
Oh, because recently they have some recall from the Walmart products, so that's why have the tarnished reputation for them.
Yeah, basically it's Walmart's issue, but finally Walmart, if it happens several times, Walmart will find Perigo, we find some problem with your issue, but until now they just got one recall, so that's not a problem.
Which competitor would Walmart favor in that kind of environment? I mean, who are their big competitors from the consumer perspective?
I think from the store brand, we didn't find that there's not a replacement directly for a store brand, but just generics in general, like the shelf space can be filled by other companies.
One of the challenges in that industry is manufacturing, in terms of being able to manufacture without contamination.
Yeah.
How many manufacturing facilities and where are they?
They have them globally. There's one in Israel. There are several in the United States.
They recently moved the API from Europe to India to maintain its cost leadership. And I just want to mention that Walmart, it will be difficult for Walmart to find another supplier as huge as Perigo, because Perigo supplies 80% of the total OTC market.
Mm-hmm.
If Perigo don't supply, I mean, it's almost a horrible situation for Walmart. Walmart survives based on its efficiency of supply chain.
In one of your appendix, you have the insider ownership. Can you talk a little bit about that? If you're comfortable with the amount of insider ownership, the trends, and who in the is it highly institutional owned stock?
Could you go to the inside?
Mouse not working. Yeah, mouse wasn't working. It's unfortunate. Yes, it was.
Basically, recently we didn't see any any insiders sell their stocks, and it's part of the corporate governance to issue those stocks to the insiders. Stock options, because encourage the management team to have a better performance when they run the business. It's always good to know that they didn't trade their securities in the market because they have enough confidence their stocks held at their hands will improve and they will got a more profitable return in the future.
I would just like to add, you asked as far as the trend goes. We actually are comfortable with that because they've been increasing their stock-based compensation for the past several years. So it's helping to better align the interests of the investors and the management.
They also have really low turnover in their management team and really high rating from their governance rating.
a question about the competition. You'd mentioned that each segment tends to have its own competition. How come you guys didn't do a sum of parts valuation?
Well, as far as our free cash flow to equity model goes,
Mhm.
those forecasts were based on some of the parts valuation.
Mhm.
So we have different growth rates for each segment, things of that nature.
Do you think there would be different valuations for each part of the business though?
Yeah,
Yeah.
I mean, just because of the size of the business relative to the overall corporation, like consumer healthcare would probably make up the largest portion of it since it's the largest portion of their business.
I mean, just in terms of like, you know, the consumer healthcare has certain characteristics about it that are different than the generic pharmaceuticals, and so they would be valued at different multiples, not necessarily as a percentage of the whole company, but, you know, if you broke the company up,
Right.
so to say.
Well, basically, we use the different growth rate because we incorporate the different factors could influence different industries in the segments. So we go through the balance sheet, income statement, balance sheet, and finally get our cash flow. I think we incorporated the factors you mentioned in our free cash flow to equity model. And at the same time, as a whole, because of the strong competence of the Paragon itself, it actually contributes to the competition of those segments. So I would say Paragon has a stronger advantage over other companies because it's competition positioning
Mm-hmm.
overall market.
One of the, they're obviously a big player in the consumer healthcare business, as you mentioned, regarding in terms of who Walmart may, should they stumble, who Walmart would actually look toward. But on the generic pharmaceutical side, there are very strong competitors, companies like Mylan, companies like Teva. And obviously margins are higher there, but what about that competitive perspective? And are they looking to grow that business, do you know, by acquisition? And then if you could talk a little bit too about acquisition risk.
Well, I mean,
Yeah,
sorry,
go ahead.
Well, you.
Actually, one-fourth of those, I call it the RX, which is prescription pharmaceutical. Paragon historically maintained the leadership in this industry, and one-fourth of its prescription pharmaceuticals, they got the 180-day exclusive day. Means they have 180 days to manufacture a molecule. The other manufacturers can never have the opportunity, they can't manufacture during the exclusive days. And Paragon spent more R&D expenses during recent, very late fiscal years expenses on their research and development, especially for the prescription prescription pharmaceutical. So that indicates Paragon will have more competence to manufacture more prescription pharmaceuticals.
I'd just like to add to that, they also, as far as their prescription business goes, they're more in the line of topical prescriptions, and there aren't really that many competitors in that segment. So because of that, it's also something we included in the risk matrix, that other companies would be taking advantage of the patent cliff more so than they are. But at the same time, it's part of their strategy that what they do is when the competition is intense and the margins are low because of that, they wait until people decide to quit operating in that segment, the margins start coming back up, and that's when they enter the business.
Their profit margins have expanded quite a bit in the past 5 years. Do you view that as sustainable?
Not perpetually, no. But I would say for the next 5 years or so, I definitely think it's something that can be maintained.
Not the growth rate in the margins necessarily, but just that they stay
Yeah.
where they are.
Yeah. Actually, I believe it will grow because they just add the pet segment in their structure, and which is actually a portfolio, profitable segment around 90% operating margin, but we include that growth rate at 0 because we want to have a very conservative assumption. We still got the buy recommendation. That's the reason we strongly recommend this company and for investors.
Also, to add to that, there is a company that's approximately the same size as Surgeons that's publicly traded, PetMeds, and they have a 5-year earnings growth, compound annual growth rate of around 9%. So the fact that we included 0% growth in that segment and we're still able to get, you know, a buy recommendation just goes to show how conservative the numbers that we used are and how confident we are in our valuation.
Now, since you did the presentation, as you mentioned, the stock price has been going up and you have a target of 125.50. At what point, as a portfolio manager, do you tell me not to buy it? Is there a price?
I guess it depends on your required return. I would say in the teens is probably somewhere where I would consider but it would depend from what kind of method you're using or what kind of.
This company is kind of reinvesting the cash flow in their future developments. So I think I strongly recommend you buy the stock of this company. Even though use our very conservative assumptions against capital gain. That's just the capital gain, 18.09%. Even you buy it now, so it's really a great investment.
What?
One more time.
Oh, sorry.
Thank you very much.
Thank you.
Thank you.